All right, we're going to start by checking out the S&P 500. As you can see here, we've been overbought in the S&P for several weeks now. So, and we're actually in one of the worst months of the year, seasonality wise. So if we go look at our average monthly stock market returns, you see that February has traditionally been one of the worst. The other two worst are August, September. So that being said, we have, when we look at the futures, let's look at the futures for today. We can see that the Dow futures, S&P, and NASDAQ are down 2.41%. The news today was, that came out on Friday, was that, let me see, hold on. Stock futures plummet after Trump imposes sweeping tariffs. This is really big. This is something none of us have ever experienced before. It's Trump just imposed tariffs on our allies, Mexico and Canada. And what makes this so important is this isn't over. It's it involves a lot of uncertainty for the stock market. Every company is kind of wondering, what are the costs going to be going forward? What's my profitability going to be? Every business model in the stock market is changing with this news story. And there is a person called John Luden, a partner in independent economics, former economist at the OECD, said the main consequence of the tariffs would be inflation, with all countries likely to get hurt, including the US. The big quote for this person is the 80-year era of stability in the rules and conduct of economic and financial relations between countries ended today. And basically, the US has officially broken the global trading system, Canada first. So this is why we're opening down tomorrow in the stock market. So basically, we imposed tariffs on Canada. They immediately imposed tariffs on the United States. So we're going to review what leads to a crash in the stock market. We've been saying for many months that random acts by Trump and basically this tariffs was, we knew it might happen. There were signals that it might be in March, and here it starts in September, in this weekend. So, all right, so we have all kind of consequences from the tariffs announcement. Number one, we have half of our groceries are imported from Mexico and Canada. We also have we also import a lot of oil. And so this is going to affect the price of oil. It's going to affect the dollar. The dollar gets stronger whenever there's a sign of the United States bringing in tariff money. All right, so let's review some of our talking points. Okay, so we left January and now we're moving into February. We have a big earnings reports this week with big tech stocks. So even though we're going to open down on Monday morning, we're going to have all week long news from the big companies that could allow the stock market to recover in some way. But let's not mistake this at all. The news story about the tariffs is uncharted territory for the stock market and for everyone that's an investor. No one really knows what's going to go on and happen next. Basically, according to this guy, the U.S. has broken the global trading system. We don't know what the United States has in mind, what the new reality is. Are we going to be by ourselves? Are we gonna make everything ourselves and not do business with over people in different countries? I don't know, but it's becoming evident that the business models of every stock that we're following is going to change because of this. Some will change more or less. We're going to go over how stocks are affected by this news. Um, all right, so let's look at some more of our talking points. Mm, okay, so the 10-year is down 2.3% in the last week. We start off the week with a China company saying that they developed an AI model that is much more efficient than what Americans have been using. And because of that, all the major tech stocks, particularly AI stocks, went down a lot. And a lot of times whenever there's uncertainty in the market, the 10-year treasury and the 2-year treasury have a large demand because in uncertain times, investors reach for security and safety, which is the US Treasury. And the more people that are buying US Treasuries, the lower the yield goes. So that's a flight to safety, it's called. So the 10-year is probably going to go down further this week. Um, okay, so we're still at a point right now where we're overbought in the stock market. So we do have a while to go before we're oversold. So even if we sell off today, we're still in an overbought position. So now the catalyst for the market to go down, we've been following these for quite a while, every week, and we've been waiting, you know, and waiting for a couple of these to happen. Okay, first of all, uncertainty with tariffs being imposed on our trade partners. The market doesn't know how profitable companies are going to be in that environment. No one has been through such an intensive tariff situation as this. Okay, so the tit for tat, banning chips, banning exports from China, we could have retaliatory measures from the countries that we tariff. For instance, Canada had imposed tariffs on American goods, 25% tariffs on American goods, and that might affect the demand for American products and might slow our economy down. Also, we imposed 10% tariffs on China, and China could turn around and not allow us to have some of the rare earth metals and other items that we need to be productive in our industries. So this is all starting to happen as of as of last night. Basically, what worked in the past 80 years is going to change in a major way. So, in other words, if you have risk in your portfolio, anything with a high PE or a PEG ratio that's high, then there's a very good chance that stocks will be selling off until we get like a reasonable valuation in the stock market. You see, so we were worried about Trump probably moving the markets daily. So over the weekend, we had on Friday we had the notice that Trump would impose tariffs on Saturday, and that was unexpected. Um, Wall Street likes certainty. Now, this is going to happen throughout the Trump presidency, so don't get comfortable with this being the last surprise. Um, so right now, what would work in this environment, stocks with lower PE ratios that aren't extended, with low PEG ratios around 1 or lower. Safe business models that are consistent over time. And I'll add to this, domestic oriented. We have a lot of stocks that we're following right now, such as T-Mobile and Berkshire Hathaway, that do a majority of their business in America. Those will be safe from tariffs and, for the most part, what's going on geopolitically right now. And we'll talk about that later. Um, okay, so let's look at, okay, so other things to be doing good in this environment, high yielding stocks. Stocks, we know that the 10-year treasury is going to be going down due to a flight to safety. So there's going to be a demand for safe investments with yields, such as the healthcare, telecom, financials, energy, and utilities. So we're going to follow those sectors as safe havens in when the market is crazy. Okay, so let's look at where we are in the stock market. We're halfway between overbought and over the two channel lines. So with the news we had about tariffs, there's a very good chance we're going to at least touch the bottom end of this channel line. If we break through that, then we have to look at these moving averages. You can see we're currently between the 100 and 200-day moving average. If we sell off, we'll most likely go down to this 150-day moving average. And then if we break through that, we'll go to the 200-day moving average. And if we continue selling after that, we have to look back at where there has been support in the past. You can see right here is a good level. Here we had support at that point, and then we had some support here. And then we have to go back to right here for our next level of support in case of a market sell-off. So but let's hope it doesn't get that far. Right now we're overbought, so there could be some selling until we get a point where we're oversold. And so far we're above the moving averages. So let's hope the 150-day average, which is the green line here, holds. All right, so you can see the 10-year Treasury is going down. You can see right here it's going down in conjunction with the S&P. And that's because there's a flight to safety currently. We have people reaching for something that's safe. That's making the yield for the 10-year go down. And there's possible unwind of the AI trade. So let's look at some of our major variables. Okay, crude oil is basically down a little bit since last week. Overnight, there are signs that oil is going to go up. We had a 10% tariff on oil from Canada. That's going to increase the price of oil in America. And there's a good chance that, mm, well, there's a good chance the price of oil is going to go up in the near term. So the US dollar, ever since the tariffs were announced, it has been going up a lot. So that's going to affect the price of commodities. So as a stronger US dollar tends to drive gold prices lower and all commodities lower because commodities are priced in dollars. We do have gold up a little bit this week, but um, I would think that it would be going lower. That's contrary to if the market is selling off. A lot of times people gravitate towards gold as a um, something that's consistent over time. And okay, so well, we'll keep an eye on that. So you can see the dollar has gone up an extreme amount in the last couple of days because of the tariffs. So that's going to affect a lot of the multinational companies' earnings. We'll go over Colgate's warning or their earnings later on today and how they were affected by the US dollar strength. Okay, fear greed index. People are neutral right now, neither fearful or greedy. So it was fearful. So we've been going from fear, now we're back to neutral. And it looks like this week we're going to go back to fear. So we're not at a point where we're oversold and there's bargains out there. We have to wait for extreme fear to start looking for things to buy. Okay, so the AA Association of Individual Investors Survey, um, they're bullish, and the translation is take some profits off the table or don't buy. And the VIX is 16.343 today. I'm sure it's after the opening, it's going to be much higher. People are starting to get very sprayed and they're uncertain. And when there's uncertainty in the stock market, people think it's called fire, shoot, aim, or something like that. So basically, it's people would have a tendency to throw the baby out with the bathwater and basically then figure out what ramifications the current news has on their stocks. Okay, so let's look at our investing emotional graph. Right now, we're at a point where we're between fear and capitulation. We have an unknown, uncertainty. We have tariffs, the trade war starting. And a lot of companies won't be able to predict what they're going to be earning next quarter. A lot of investors aren't going to have confidence. We're unwinding some of our confidence in the AI trade this week. So with that, I'm going to review the issues that may lead to a crash. We've been keeping track of these, and some of these are actually coming to fruition that might allow us to have a crash. So Magnificent Seven stocks, where a lot of them are reporting this week, if they have bad earnings or have any kind of indication that there is a lack of demand for AI, then we could have a sell-off in the Magnificent Seven, which could cause the whole stock market to crash. Um, okay, and we had DeepSeek this week come out with a model for AI that was much more efficient than other companies supposedly, and that left a lot of investors not confident in the AI trade. So let's hope it doesn't unwind anymore. The consumer debt, okay, we're still worried about that. High gas prices. Um, we're putting a tariff on the Canadian oil, a 10% tariff. So we're going to have higher gas prices because of that. Um, and a counter to that is a strong dollar should bring down the cost of commodities. So that might cancel each other out. I'm not sure. We mentioned tariff threats before as a reason the stock market could crash. And it seems like we're hitting the hornet's nest where we had a global trade situation that was perfect for our country for quite a while. And then it seems like trying we're 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 resetting the whole global trade situation right now. No one knows what's going to happen next. So let's review this because it's really important because right now the PE, the people are willing to pay a certain amount for a PE or for the S&P 500 um, at different interest rates. So right now we're the PE ratio for the S&P is around 24.79. The average PE for the stock market is 17. So if we do a quick calculation, 17 divided by 24.79, that's a 30% lower than where we're at right now. So we can sell off in the stock market 30% and then basically be at a median average of the S&P PE ratio. So um, don't be surprised if we sell off some. Okay, so I'm going to look at the first to worst right now. We can see the best performing stocks last year, which is IT, is down so far this year. And the best performing stock, which is communication services, is up 8%. So that's been doing good last year and the year before. So let's look again at the best and the worst. So IT is the worst performing sector, then real estate, consumer staples, and the S&P. The ones doing the best are communication services, financial, healthcare. So at the beginning of the year, we expected healthcare, financials, and we expected the energy sector to be doing good also. And so they are actually doing much better. They're probably one of the best sectors so far this year. Um, okay, let's look at, hold up for a second. I have to pull this up. Let's look at some of the best performing and worst performing stocks in the stock market. We had a theme at the beginning of this year that financials would do well because of deregulation and because they've been out of favor for quite a while, and they pay a dividend. You can see that the stocks that pay a dividend and fall within our theme from the beginning of the year, which is revert to the mean, healthcare, telecom, financials, energy, utilities will do better because there's going to be REITs for yield and for safe investments. So we have Franklin Resources, they do financial investing. We have Vertex Pharmaceuticals, they just came out with a drug that, a painkiller drug that was just approved. We have AbbVie, that's one of the stocks we're following, it has a high dividend and it's growing steadily. We have, let me see, Corning is a manufacturer of fiber optic for data centers. We have, let me see, Baker Hughes. This is one we highlighted a couple weeks ago as an undervalued oil stock with the price with the Canadian oil being tariffed 10%, we're going to have a high demand for pumping oil in America, and that's going to help Baker Hughes. We have, well, let's look at some of the ones doing the worst today. Decker's Outdoor, they make the Uggs and Hoka shoes. They posted decent earnings with decent um, forward projections, but they got taken to the cleaners. Not sure why. Um, okay, we see the theme here. I don't see a theme. Hess is a company it's an oil company, Occidental Petroleum, an oil company, Apache oil company. Colgate-Palmolive, um, they're down 4.6% because of the strong dollar affected their earnings. Um, and I'll go over that later on. Chevron, another oil company. So we have a lot of oil companies in the top decliners. Um, all right, so let's look at some of the NASDAQ up and down. Okay, we have a lot of these are related to the AI trade. We have ARM Holdings. We have Broadcom. They make software for the data centers, and they make chips for the data centers. We have Alphabet. They're an AI play. Palantir, an AI play. Alphabet, and Amazon. So we have a good portion of these top gainers in AI-related stocks, probably recovering from the big sell-off on Monday. So, all right, that's all we can get from that. Let's go back to our talking points. Right, so, okay, so right now we're going to open up low, 2.5% lower on the NASDAQ. So we're expecting it to go at least go down to the bottom of this trend line. By the midweek or maybe at the end of this week, we'll be oversold. Then we start looking possible to buy things. Um, okay, let's look at, we already went over this stuff. Okay, let's review Dan Now's picks from the beginning of the year. His first pick was cash. Now, he mentioned there could be an unwind of the AI trade. So he said 4% yield in a money market fund and dry powder. And today we're going to have a sell-off, and we had a huge down day this past Monday. It's amazing that we had a huge down day this past Monday um, due to the fears of DeepSeek being a challenger for AI. But at the end of the week, the QQQ was break even. So we got a double, we got a chance to lighten up if we were overextended, at the end of this week. But basically, Dan Niles thinks that thought at the beginning of the year that we should have a good portion of our money, let's say a fourth of our money, fifth, wait, he has four picks, five picks, so maybe 20% of your money in cash to be ready for whatever happens. Um, so KWeb, K no K KBWB, the um, banking ETF is up 9.4%. And the IJJ is up. This is the small medium cap ETF. It's 4%. And Cisco is only up 2%. And this ADTN is up 27%. So far his meta is actually has up another 17% this year. So it continues to be a really good trade. All right, so let's review Dan Now's um, message to us at the beginning of the year. The US dollar is up 7%. It will affect the earnings of multinationals. We're going to go over how it affected Colgate-Palmolive this week. You can see that Colgate-Palmolive was one of the ones that went down 4% this week in our top stocks. So Colgate-Palmolive had 80% of their sales overseas. So because of that, they they earned basically 7% less on those purchases or more. Okay, so he said multiples are high, 25 for the S&P. So S&P usually trades at 19 PE, which is 30% less than now. He said tariffs will cause inflation, and inflation is going to be something we have to really keep our eye on. And all right. So what he said at the beginning of the year is actually coming true. And one thing that we're going to find out this week is if there's a pause in AI spending. Meta and Microsoft last week said that there isn't a pause and they're going to continue to spend. And Facebook said they're going to continue to spend. So we're going to find out this week if Google is going to continue to spend on AI. All right. So, okay. So Dan Now's KBWB Invesco Bank ETF top holdings. You can see so far this year, Citigroup, Capital One, Goldman Sachs, these are all winning trades, the top 10. And that's probably why the ETF is up on near 10% so far this year. And you can see that they all have a relatively low PE ratio. They pay a dividend, and they're going to benefit from deregulation. I don't think they're going to be affected too much for tariffs because most of their activity is in America and not a huge portion is overseas. Um, okay, so let's look at okay, this is really big. This is really big. You're going to have a lot of ramifications of these tariffs. Um, and especially if we continue to other countries. I'm just worried that the United States might not be able to sell its goods to other countries anymore. For instance, in Canada, there are boycotts of American goods. For instance, Canadians have been told not to buy American liquor. So if that happens, this could backfire on America. Um, we will see. We don't know what's going to happen. Um, okay, so I pulled this out from our talking points that we made in our notes. A playbook for surviving a market crash. Okay, if the market is down, limit down, and you're afraid it's going to go down more, you have to think about if the crash is going to affect your position in 1 year or 10 years. Is this going to be something that's flighting, or is it going to really affect the long-term profitability of your stock? Um, you have to look at the net asset values of ETFs, the fair values of stocks. So, for instance, if a stock is trading at a fair value below where it's currently trading at, then you have a margin of safety. For instance, if Microsoft is trading at $300 a share and its fair value is $400 a share, then then the stock probably wouldn't go down as much because it's undervalued. But if you have a stock like Palantir, for instance, that has a 120 PE ratio and it's only grown maybe at 30%, there's a great deal of room for that stock to go down. So you have to look at the PEG ratio of the stock. And whenever it's around 1, if the stocks are all selling off in the stock market, a lot of times the quality stocks sell down to maybe at most the PEG ratio of 1. That's where it's fairly valued. And a lot of times when there's a crash of 10 to 20%, in a short amount of time, maybe 1 to 2 months or faster, the stock market recovers. Not every time. A lot of times, back in the year 2000, you had a sell-off of 20% and then a rally of 10%, and then yet another sell-off of 40%. So you just have to realize that selling into a correction is a lot of times is not a good thing to do. When you sell during a sell-off, you have to make 3 decisions right. This is why it's so dangerous to sell during a sell-off. You have to know when to sell, realize the bid and ask are not in your favor. If you sell at market open tomorrow morning, whenever the stock market's down, there's a wide gap between the bid and the ask, leading an individual investor to get a raw deal. Um, you have to decide when to sell, and then when do you get back in? Today, tomorrow, or when it's down even lower? So if you sold out of your stock today and it goes lower, at what point in time can you decide I'm going to get back in? And timing that is really, really difficult. That's why for me, I like to just buy and hold. Um, if you sell the stock, you have to decide to replace it with something better than what you have sold and make up for any capital gains that you have to pay on what you just sold. So it's a very dangerous situation to sell during a market sell-off. The best thing to do is to stay put and to wait for the dust to settle. All right, so let's review things that happen when there's a market sell-off. The U.S. Treasuries go down. So you can see um, the U.S. Treasury. Let's look at the U.S. Treasury for today. You can see that the 10-year Treasury is down a lot. This is 0.044. Um, and that's because whenever the market is going to open lower, people gravitate to something that's a little bit more safe. And the U.S. 10-year Treasury is the safest investment. And the more demand for this, the lower the yield is going to be. So that's why it's lower today. So the U.S. Treasury goes down. You have large stocks are usually the most stable in a sell-off um, because even if there are tariffs, a lot of times the larger companies can handle the tariffs or any random situation better because they're well capitalized and they usually have the workarounds for any major situation that could happen. And just think about the pandemic, how all the big tech stocks survived and thrived in that situation, and they adapted. So good stocks will make it through. The bigger stocks will make it through, the challenging situations. After a big sell-off, there's often a bounce. So you have to know that if there is a sell-off, there's going to be a point in time when the shorts have to cover their positions, and there's a huge rally in a short amount of time. And that happened during the pandemic. It happened in major market crashes in the past 10 years. Keep in mind that the earnings are around the corner this week for a lot of big tech stocks. We're going to go over that next. Um, okay, you can see that on Monday, tomorrow, we have Palantir reporting their earnings. We have PepsiCo, Alphabet, AMD, Merck, and PayPal reporting on Tuesday. Walt Disney, Novo Nordisk, and Ford on Wednesday. You have Eli Lilly and Amazon and reporting on Thursday. So we have a lot of big stocks reporting this week. So that could be a catalyst. Alphabet is one of the bigger ones. That could be a catalyst for stocks to at least bounce or stabilize. All right. Okay, so here's some things to keep in mind. 7 times a year, on average, stocks dip 3%. So we're going to go down 3% on Monday. And that usually happens 7 times a year. 3 times a year, there's a 5% mild correction. About once a year, we'll have a 10% correction. Every 1.5 years, we have a 15% correction. And every 2.7 years, we have a bear market. So that is what's called the volatility. I mean, that's the toll we pay to invest. So Charlie Munger once said, I'll paraphrase him. Um, if you want good returns, you have to be an adult and be able to hold your stock through bad times. Here's an article. Jim Cramer says he names 6 stocks worth looking at if there's a major sell-off. And why would do you want to look at these stocks? Okay, let's look at Microsoft. Um, Microsoft has a very diversified business model. They have money from Office, they get money from um, the cloud, they have money from AI, they have money from gaming. So they have a very diverse amount of customers that um, will allow them to thrive in any environment. Waste management. Um, let's say, how are they affected by tariffs? They're not. They're a America only company, so they're not going to be affected by um, any tariffs overseas. And Meta, um, they're they don't have a whole lot of input costs. They're not going to be buying metal or oil overseas. A lot of they're not really affected a whole lot by um, tariffs overseas. They could have some kind of boycott from American companies that might hurt Meta, because they have a lot of business overseas. Strong dollar could hurt Meta's earnings. Um, but in general, they have a very stable environment with a growing customer base. Procter and Gamble, in good times and bad, you're still going to use Tide, and you're still going to use a lot of the staples that they sell, such as Oral-B toothbrush and um, toilet paper, etc. So it's a slowdown stock. They pay a dividend, and um, they're probably a good company for good times and bad. And Waste Management also pays a dividend. Microsoft pays a dividend too, so that they have that in common. And Procter and Gamble, there are they're also trying to limit the number of products that they have and focus on only profitable, the highest profitability companies. Let's look at General Electric. Okay, General Electric, they sell aircraft engines right now. And Jim Cramer says they're the fastest growing aerospace play. And maybe, maybe that they might be affected by tariffs. Maybe if there's um, tariffs on Boeing or something like that going forward, they might be affected by that. But there's no tariff right now that would affect GE. ServiceNow, they're pretty much a America. Most of their business is in America, I think, and they're an AI related company. They're very high PE ratio though. Okay, so that was a good little exercise. Um, let's look at this news story. Colgate-Palmolive stock falls as foreign exchange rates hurt sales. Okay, we've been saying for like a couple, all year basically, that the dollar has been going up, and that will affect the foreign exchange rate. Just for fun, I looked at Colgate-Palmolive's revenue based on region, and you can see North America is only 26% of their total sales revenue. 75%, 74% is overseas. So each one of the American dollar is strong. That means they're going to get less money from each of these other parts of the world. So that is, and they went down 5% because of this. And let me see. So the reason why this exercise we're doing right here is important is whenever you're investing, you have to know how much of your company that you own does business overseas. So we have stocks like Google that does a lot of business overseas. So they're going to be they're going to probably mention foreign exchange rate during their conference call on Tuesday, and we got to be ready for that. And it's a zero sum game. Some some quarters the US dollar is strong, and it's a headwind for the company. Sometimes the US dollar is weak, and that'll help the earnings of the stock. So there's a term called constant currency. A lot of companies would say, well, constant currency, we're up 5% across all the countries we do business in. And um, but in general, that's something to think about whenever you're investing. But it's a zero-sum game, meaning it's sometimes the US dollar that's strong helps, I mean, hurts, and then whenever it's weak, it helps it. So that's a good exercise. So we had this past Monday, we had a story about China's DeepSeek sets off an AI market rout. We talked about this last week. I just wanted to get some talking points about this. Um, the froth may come out of the AI market. There's a lot loss of confidence. So a lot of the stocks that had a PEG ratio greater than one might have, um, with a lack of confidence, this could be an excuse to sell the AI trade. Some of the biggest losses were in AI infrastructure this past Monday. We had NVIDIA, Broadcom, Micron down like 17%, and Constellation Energy, Vista, was down 17%. So, and there's a lot of people that still don't know if this DeepSeek stole a one-time stole the a model from um, OpenAI or not, but it's a lot of people just sold and then waited to find out if it was true. All right, so okay, so Apple had earnings come out and they were decent. They were up 3% after hours, but they closed around flat for the day. So it's great to know that the big tech stocks are doing good. They've all reported good earnings. So we're going to wait for Amazon and Google this week. Um, Tom Lee was on in this link here. He said that the DeepSeek sell-off was an overreaction. Um, he's uh he's been a bull. He's been a cheerleader for the big tech stocks in the stock market for years, and sometimes you got to take um, what he says with a grain of salt. Right now, he's saying that NVIDIA, Amazon, JP Morgan, Meta, and Google are his top picks for this year. So we're going to keep track of those stocks also, seeing that um, um, they are his best picks. And JP Morgan is an example of a financial that um, will benefit from deregulation. You think Tom Lee says financials are his favorite sector. And that's very similar to Dan Niles, where he picked the banking ETF. Okay, so I thought it'd be interesting to go through a screen. We had this basically the same stocks as last week, but I thought it'd be interesting to go through some of how each of these stocks are affected by tariffs. Okay, Eli Lilly. A lot of their sales are in America, most of their sales, but they have a lot of inputs from other countries. Like they get some of their raw goods from China, and if there's a trade war, they might not be able to get those those items for making their drugs. So how much will these drugs be affected? I'm not sure, but we know that the drugs that Eli Lilly sells overseas are already much lower price than what you can buy it for here in America. So even if there was a tariff, there would still be a consistent demand overseas. Netflix is primarily most of their customers are in America, although they're expanding globally. Um, and and they don't have a whole lot of input costs. So they don't have to buy tungsten from China or coffee from Brazil. So they're not as affected by tariffs. T-Mobile isn't primarily in T-Mobile US is an American company. So most of their business is in America. So they're not affected by tariffs. These are all the ones I highlighted here aren't affected by tariffs or they're helped by tariffs. Okay, Schwab and um, HDFC Bank Limited, they're banks. They're going to be helped by deregulation. And let me see. We have Comcast. They're a provider of broadband solutions, and so they have most of their customers are in America, so they're not going to be tariff oriented. We have Interactive Brokers. They're a stockbroker. So they mostly America for customers, and they don't have any input costs or input anything that is tariffed basically. We have some more energy companies, EOG and Energy Transfer. We have Block, which is a financial company. They do Cash App, a couple. They do e-commerce for small businesses. Barclays, a bank from Europe. We have Dominion and Baker Hughes. We talked about Baker Hughes as a company that would benefit if there are tariffs, 10% tariffs from Canada, then there would be a higher demand for oil service drilling in America. So America is going to be pumping more oil if the price of oil is escalated. Okay, so that was a good exercise. And Morgan Stanley is another company that would benefit. We have Royal Bank of Canada. Um, all right, so we have a lot of banks in our screen this week. So that kind of matches. They're considered, quality companies that, are decent valuations. That kind of matches Dan Niles and Tom Lee's financials picks for this year. All right, we'll keep our eyes on those. Um, Remember at the beginning of whenever Trump was elected, we said chaos is coming, unpredictable, volatile markets ahead. And Trump said at the first, as soon as he was elected, he warns the EU tariffs are on the way unless it buys more U.S. oil. So there are going to be threats, and there are going to be everyday tariff threats and unknowns in the stock market. So it's going to be very volatile. You got to be willing to hold whatever you have right now because it's going to be like a wild ride for the next 4 years. All right, but that was an excellent excursion. Um, I think that's all I had to say for today. If you have any questions, let me know and I'll research that for you for next time. All right. Happy investing, everybody. See you next time.